This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization. Michael Parsons Trading Institute presents Balanced Dynamics, the video series. Disclaimer required by the CFTC: the trading of any financial instrument is risky and can cause substantial loss, including the trading of futures, stocks, mutual funds, or options. The use of stops may not limit losses to the intended amounts. Only risk capital should be used to trade futures, stocks, or options on futures or stocks, or mutual funds, or any other financial instruments, whether in conjunction with this product or otherwise. All investments and trades carry risk, and you ultimately make all trading decisions, and you are solely and individually responsible for the decisions and the results of those decisions. Past performance is not indicative of the future results. Not all trades were executed in the actual markets, and the impact of the results can be over or understated. The results and sources are believed to be reliable, but no assurance is made for accuracy or completeness, and is subject to change without notice. You must be aware of the risk and be willing to accept them in order to invest in any financial instrument, regardless of the market. Don't trade with money you can't afford to lose. This is neither a solicitation nor an offer to buy, sell any financial instrument. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed in any of our trading materials or websites. In other words, if you risk it, you can lose it. Balanced Dynamics video number 5. Methods of trading balanced targets. Now that we've learned the basics of how to determine a balanced target, we now need to understand how to actually trade them. And at this point, it's important for me to emphasize that balanced targets, well, they're not of their own accord a complete system. They are a tool for determining where the odds favor an actual trade. Therefore, you will need other methods to enhance that trading, and we'll talk about that in a moment. Beyond a methodology, there are two other factors that play an important role to your trading success, and that involves your trade management as well as your emotional control. And for a moment, let's talk about trade management, or good trade management, and what that means. While we are not going to deal with this in detail here, these factors should play a role in enabling you to manage your trade successfully by doing these things. The first is you want to avoid overtrading. Don't trade every swing. Not every swing, though you may actually have a target, is going to work out favorably. Look for the ones of good quality. 2. Plan your trade. And that includes the stops, the entries, the exits, and so on. The reason for this is that if you've planned your trade all out, then you've completed your analysis. You've made sure that you understood the trade that you're entering into. And that leaves out the possibility that you may have just haphazardly jumped into something that you just don't know what you're really jumping into. 3. Ask yourself, do the multiple time frames agree? Now, as we talked about earlier, multiple time frames have a great influence on the success of a trade. A higher time frame indicating that this is the direction of trade, well, then you have the power behind you. A smaller time frame saying that agrees with the bias of the market, well, then that reduces your risk. And that leads to the 3 following items. 4, which are enter with the least amount of risk. In other words, you want to enter where you're close to your stop. The further you're away from your stop, the more risk you accept. Now, you have to allow some room, but you don't have to give away yourself or actually extend yourself overly in regard to entering a trade, particularly not when dealing with balanced targets. 5, take trades with high profit potential. Look for where the potential swings are much higher or greater. 6, trade in line with the overall market bias. Look at what the market is trending toward, where the market bias is indicating, and trade with it. Use that to your advantage. Some of the additional methods that we will be looking at to enhance the use of balanced targets will include 1. Target zones. 2. Channel surfing. 3. Using support and resistance. 4. Using indicators. And finally, 5. Using reversal dynamics. When it comes to trading, there are probably as many methods and techniques as there are traders. It would be impossible for us to discuss every single technique out there in relation to how they could be enhanced with balanced targeting. Suffice it to say that no matter what you're using, you can definitely use balanced targeting to improve your trading. Some popular methods, such as Fibonacci or Delta Phenomenon, or many of the other methods that are popular in today's world, we're simply not going to discuss. What we will do is discuss some unique approaches that are applicable to the method, as well as some common ones, to give you a rounded approach to how you might use balanced targeting in your trading. It is hopeful that following this, that you'll be able to adapt balanced targeting to whatever it is you're using and whatever you prefer for your trading. The first technique or method we want to discuss is that of zones. Now, there are two actual applications of the term zones. One is in with target zones, and that's where we use targets to set up a zone level where we would buy and sell, and we'll talk about that in just a moment. The first thing we want to discuss is really price zones themselves, a natural phenomenon that occurs in many markets. As you look at any market, the tendency will be that a market will form a consolidation, develop some momentum where it will move, then consolidate again, then momentum up to another form of consolidation. It does what's called a stair-step effect, either up or down. This natural phenomenon has actually another factor that's even more precise, and that is the tendency for a market to maintain certain price ranges. In other words, if you look at this market, which is the British pound against the US dollar on the daily time frame, you'll note that the tendency is that certain price levels will repeat between highs and lows. As you look at this low, for example, you'll note that the difference between the low line and the succeeding low levels is about the same price difference as the next series or section or zone that occurs. And an upper section also matches it as well when we look at the highs and the lows. This phenomenon is, while not always perfect, tends to be rather reliable. There are times, for example, where the market will peak out of that zone and still come back into it. And there are times, too, that a band, a neutral band, will form that spaces the zones apart. And you can tell them because the highs and lows that form shift beyond the other highs and lows prior to it. Typically, this occurs in a situation where there's a high amount of momentum, as you see right here. But aside from the spacing that may occur from time to time because of a strongly momentum type of market, the fact is that these zones do tend to repeat about the same range. And this is useful in a couple of ways. For one thing, they can be used as pivots. In other words, if you rise above them, then you buy. If the market declines, then you sell, right to the next zone level. An example of this would be looking at this low that we see here. Bouncing off of this would be a point to buy. When it reaches to the upper level, then it's a point to exit or sell. If the market should start to exceed it and rise above that line, then you would buy, again looking to exit or sell off the next level. If the market has very strong momentum, as we see right here, then the obvious momentum would be indication to stick with a trade to see if it's going to show any weakness, or if it's declining to show any strength, at which point then you would take your exit or change of position. Once it passes a zone level, then the anticipation is that it will reach for the next zone level. Either way. While not always occurring perfectly, you can see in many of these cases it does work very well to accomplish just that. Now, how does that prove advantageous to us? Well, the fact is, because these price zones exist, and they are a natural phenomenon, They give you another tool to estimate and plan out a trade. If you're trading just between these zones, you will find that you can do exceptionally well just with this one technique alone. But in combination with balanced targets, then you have quite an incredible power given to you. For example, this consolidation that we see here. When you look at this consolidation and consider where the balance point is, there's actually two potential balance points. There's one right here, and there's one right here at the gap. Now the gap is much stronger, but still there is something here that is established as a balance target. And although we may tend to focus more on this prior low, the fact is that when we set it up, look where it goes. Not only does price target it, but just right where the price zone level meets. And so we have a good idea as to when and where that point will occur. If we look to the next point, the balance point as we see here, and go back to the prior points, what do we see? Well, we see a target perfectly made right up here. But not just there, you also have the zone in order to help you out. You see, it creates a double method in order to be able to use the balanced targets. And obviously, because zone trading has of its own accord a good method and good ability to bring forth a profit, using balanced targeting as well in conjunction with it enhances it all the more. The next thing we want to look at is that of actual target zones. Now, unlike price zones, target zones are based solely not on price differences or specific ranges, but on the targets that are established that we use a balance to determine. Looking at any market, such as this market we're looking at, there are some obvious things that come into play that we have to consider. There are a number of things that can delay a market, such as a consolidation. There can be changes in participation or volatility that make a difference. All these factors can play a role into how the outcome will occur. Now, looking at this market, we already saw that very clearly this was a beautiful target that came in perfectly, as we see here. But it's not the only factor we had to deal with. When we look at it from other perspectives, let's see what we come up with. First off, let's do this mathematically on a price level, and we end up with a price level approximately right here at 196.99. Now that is still a good price level. If we exited out there, we would have done well. In addition to that, we're also looking at a time factor, and remember, these time factors can be easily skewed because of change in volatility, but we're looking at a time factor that actually indicated the market should have came to its point here. So obviously, this was delayed in regard to in meeting its price level or target line. These are all factors that, when trading the balance targets, that we'd have to consider. So how do we deal with this? Well, because there are changes, the odds are that the market will not meet in both directions. In other words, while it might meet the price target line, it may not meet the mathematical line. Or it may meet the mathematical level, but not the target line. That factor means that you have to look at it within a range basis. Whatever the difference between the two, that's what you establish to set up a range that you're going to look to trade, enter, or exit. By establishing a range, we in effect establish that we are giving the market a little room for error, and while we may not get the perfect price within that range, we will avoid the missed opportunities that can result simply because we're trying to get both to coordinate together. A target line may not actually be met simply because the market delays too long before it reaches it. A price level may not be met simply because it is, as is situated, a little too high for the market, and yet still the price target comes in based on the balance point. It depends on the profile and the setup of the market. By allowing a range a target range, we establish a little bit more room to work with. Now, that means one other factor that we have to consider in our trading, and that's the fact that, well, we're not going to get the best price, and we have to look at the situation as it follows up to determine our next move. For example, here we may have exited somewhere in this range, but then we see a consolidation that develops, and we may wait for that consolidation to establish a breakout before taking a trade. In any case, we would be looking at the range and the pattern that develops following it. Now, what I mean by this is simply this one fact. Every time you reach a price level that the market reacts off of, it tends to form some type of little pattern or a very clear, distinct move one way or the other. If it moves distinctly in one direction or another, then it's really easy to know what's happening. You see it making its move, and you see it developing some momentum. But if instead all it does is develop a consolidation pattern, well, then we have to look at the consolidation pattern and use a pattern basis for trading. We can use smaller targets, or we can use the breakout of that pattern. So let's consider how we would use a consolidation and a breakout of that to make a trade. Consolidation patterns are nothing new, and many traders are very familiar with them. There are literally hundreds of patterns to choose from, but rather than discuss specific patterns, all we're going to discuss and need, really, are specific parameters to establish in regard to any pattern that develops. Now, consolidation is not difficult to determine or see. The market gets hung up in a certain price zone and bounces back and forth, and sometimes the pattern's large, sometimes it's much smaller. In any event, it does tend to form similar highs or lows, or a situation where it's not really moving with any great momentum in one direction or the other, as you would see over here. This area, of course, is the ideal trading area because this is where the most profit in the shortest amount of time occurs. It's also among the easier to monitor. In the case of the consolidation, though, because the market has a tendency to form highs and lows, it sets by its own way its own parameters. An example can be seen with even this pattern, where multiple highs are established. If you look at the highs, you'll see that they repeat and set up a pattern where the market is slowly declining, although not greatly so. In addition to that, you can refine that as well as you look here and you see a secondary high where, again, a trend line can be drawn from two highs here to establish a stronger momentum in a decline here. This decline, as you see off the trend line, establishes a parameter that can be used to determine an entry. Although we're not recommending taking an entry directly off of the break of that parameter, but rather to use what we refer to as a rebound entry. Now, what is a rebound entry? A rebound entry is where a trend line is broken that's been established by multiple highs or multiple lows, as we see right here, and then a pattern forms where the market makes an attempt to redraw or return to that trend line, and in essence fails to do so and then resumes its swing. This pattern, which is typically small, establishes a secondary confirmation, once it's broken, that the trend or swing is valid. On a pattern such as this, it would be a simple matter of establishing or using the multiple highs, as you see right here, to establish a point of entry. In this case, we have a point where there's a bar break or bar split right at the point where this trend line exists. We've already broken one trend line, and at the break of the second, we have an entry to go long. This is a rebound entry. In some cases, you may wish to wait for a more solid break, because in this case, it was still technically below this trend line, as we see here. You may prefer that this is also broken. To establish that is very simple again, using parameters as you see here. Well, in this case, the market makes a rebound and does exceed it a little bit. It quickly returns once again and starts its momentum. Again, it's just a simple matter of establishing a trend line or some parameter to determine when that entry will take place, as we see right here. This secondary break, again, would qualify as a rebound entry. And this creates a low risk because the fact is that by doing so, you set up a stop that's fairly close to your entry point. If the trade fails and the market proceeds against you, well then you're not accepting that much of a risk. You're quickly out of the market. But you are in essence doubling the confirmation that the market or trade is likely to go your way. And this is the value or benefit of a rebound entry. An additional technique for anticipating breakouts is simply using smaller targets, whether it be on the same time frame or even a smaller time frame. For example, here we have a small target, just to point out one right here, that establishes the low before the market proceeds much higher. Certainly take advantage of these as often as you can. In addition to this, when we look at a market, and we're going to slide this over to a more current time and take a look at this market as it currently is showing, you can see that this market is declining as you see here. And it was expected to do so. The reason is, of course, the balance point that we can target from here. Now when we look at this as an example, or we look at the zone based on a balance point here, we end up with an area that we can anticipate the market moving to, right with this in this vicinity. Now it doesn't mean that we have to have the exact price. The fact is that because we're in the general area on this time frame, we can of course slip down to a lower time frame to refine that. But simply buying and selling within that zone and allowing a reasonable stop is oftentimes all that is needed in order to trade the market and do quite well. In any event, by using dual or multiple techniques for confirming a zone, then you end up with something much more valid than simply one single target area. You see, a zone provides you a confirmation of an area that you can expect a reaction. It is not exact, which is true, but when you're dealing with multiple confirming factors, oftentimes they will not all agree precisely. Sometimes they will. You don't have to have precision in order to make money. You don't have to capture every little penny out of the market to do quite well. And that's an important lesson that all of us as traders need to appreciate. The key is making money, not catching every single penny that the market has to offer. In helping us to do this, though, we do need some method or technique for establishing what is the limit that I'm going to allow this market to move against me before I actually exit. Setting a stop is a critical factor, and there are a number of techniques available out there, such as dynamically doing so with things such as channel lines. But there are other simple techniques that can be used or utilized to set the stop for you in a way that's quite simple and effective. As a trader, one of the most difficult skills you'll have to learn is that of setting a stop. Now, stop is a necessary evil. It basically protects you from a catastrophic loss. But the problem with stops is that, well, they're temperamental. If you don't set it right, either A, they get you out just before the market's going to move in your direction, and you lose out on all the profit that you knew you were about to make. Or B, well, you set them too wide, and you take too great of a loss when it's all said and done, when the market goes against you. How can you set them of a stop? Well, there are a number of approaches to take, and we're going to talk about a couple of them. First off, there's some obvious ones, and that has to do with what everyone else does, using a prior high or low. For example, if I'm buying here, then I would use this low and just set a stop just beyond it to establish a point of exit. Obviously, in this case, that would be a pretty substantial amount. As the market proceeds higher, then I would look for succeeding lows or highs to establish where I would set the stop. Now in this case, this has a couple of places, but as you can see, at some point the market's going to move against it. If I haven't hit a target by the time it reaches the high and turns around, then I'm possibly looking at this stop way down here. Now, I might have made the profit, but you can see how much I would have lost in the process because the stop was so low. There are other ways to set stops dynamically, and that includes the method outlined in the video series of channel surfing that we recommend. That involves using a channel to establish the point of where a stop would be hit. In this particular market, based on the geometry, the actual exit would occur right at this point. And this would be based on the fact that the trend line, or in this case channel line, would be dynamically adjusted according to the market and eventually finalize right at this point, as we see right here, the split. Thereby, the beginning of this decline would establish the exit. You can see the difference much better than trying to set a stop way down here. Well, the fact is that channels are fine. Some people are not as effective in setting a trend line or determining where the highs and lows will go. So there's another option that is available, and that is using what's referred to as a 3-bar stop. A 3-bar stop is as its name sounds, basically using 3 bars to create a stop. Now, how do you accomplish that? Well, the idea is fairly simple. If you're in a climbing market and it's trending higher, you will have higher highs and higher lows. The focus on a climbing market would be the lows because that would be the line setting the stops. As the market climbs, you'll get higher lows progressively as long as it's climbing. At some point, the market will turn around and go against that, either momentarily or substantially. When it does that, what you're looking for are the break of 3 of those lows that were established. Not just 1, not just 2, but 3. Beyond that third one, and you have a stop activated. Very simple. In a declining market, such as you see here, it would be just the opposite. The focus would be on the highs because the highs establish the limit of the market. As the market progresses lower, then you'll have a progressive declining series of highs. At some point, the market will, of course, turn around. And when it does, if it breaks 3 of those highs and goes beyond the third, then our stop would be activated. Now, we might mention here that there are situations where you have what's called a catastrophic swing or move. A strong swing, as you see right here, would be something that you'd have to take note of and, of course, get out of the market because it's obvious that something very strong is happening. In those cases, they are a little bit different and they stand out because of the length of the bars. But normally, a 3-bar stop will work exceedingly well, and let's take a look at a couple of examples. Let's take a look at this swing, and we're going to enlarge this chart a little bit so we get a better view, and focus on this climb right here, and see how this stop would work. As we progress higher, we will see higher lows progressively, and it may stall or hesitate at some point, as we see with these 2 bars here. If it goes against it, we're not going to jump out of the market right away because we're looking for a 3-bar break. This particular bar, as we see right here, breaks the first stop, but it doesn't break the second. So therefore, we are not out of the market just yet, and the market continues to progress higher, and we maintain our position. Again, progressively moving higher. And then we come to this bar. Now this bar sets a nice doji bar and starts to decline. If you look at it, we break 1, as we see here, and then we come to 2, as we see here, and then we come to 3. So we come to the third, but we don't actually break it. And the third, just to emphasize that, we'll change this to yellow so it stands out, is right here, 1, 2, 3, but we didn't break it. So therefore, the stop was not activated. The position is maintained. And the market turns around and progressively moves higher. And again, we set some additional higher lows, and as it progresses, we come to a final position, as we see right here on this bar, where the market turns around. Now it starts turning around very strongly, and of course these are much stronger bars than normal, so there's something to take note of. But even with just the stop that we have, we break 1, we break 2, and then we have 3. And we're going to change the color again so it stands out. And this is what we see. 1, 2, 3. Once we go beyond that, or approximately where this red line, and we'll change this to a black so that we know, an exit would be taken. Now obviously that's not as great as exiting out of the very top. But you can see that it's much better than losing all of this profit that we see right here, that we're likely to have lost if we stuck with the market in some other methods or techniques that we would have used. For example, using this low or even this low as a point of a stop. It's a very simple technique, and all you have to do is monitor, well, what was the lowest low that you had in the past 3 bars. Very simple. And once you set that, well, then that's basically going to be it. Now, bear in mind that if you have bars with similar price as far as lows, like consolidation, like we had back down here, then you don't count them twice. If they have similar or the same price, don't count them twice. You have to have 2 successively different prices. And so for a total of 3 price breaks that are lower than each other. The idea is, or the concept is, that you're averaging out what the normal price. And the basic theory behind this is that a market will move against it by 3 bars normally before turning around if the trend is still intact. And that proves true in many cases, not always, but it's a very simple technique that can be used. And that can be applied in a number of aspects in regard to the market. And when we go to the other areas that we can look at, an example can be where we looked at this trend and the swing. We have a similar situation, again, of progressively higher lows. And you can see where the market came down and broke 1 but not 2, and then progressively moved higher. And we could go on up all the way up here, and we'll note that as we get to this point, once we break this particular low, which was the high, as the market turned around, as we see here, we have, in essence, 1 break, 2, and 3. And here's the third one here. Let's highlight this one, if we can get it to do so, and change its color. And here's the stop. So a stop would be established right about just below that, which would be right here. And so the stop or exit would have been taken right here. Much better than what it potentially could have been had we used some other method, perhaps a prior low, for example, and have an exit much lower as we saw before. Now, that simple stop system is effective in a lot of cases, but the problem you will run into is if you have a catastrophic move. For example, what you see right here, or these strong swings here. If you have a very strong swing that obviously is showing some excessive power and moving, then perhaps it's best to get out early, recognizing that something more is happening in the market, particularly if it's a news or report-generated impact, and as a result, it's likely to continue substantially. These cases are abnormal, and what you're focusing on a 3-bar break is, or 3-bar stop, is the fact that you're dealing with what you are analyzing as normal activity for that market. Abnormal activity, well, then you're going to have use common sense in regard to that stop and get out of the market. But typically, aside from that, the 3-bar stop works quite effectively. And it is another technique to add to your arsenal in regard to using this. Now, how does that apply in regard to the balance? Well, obviously, when you're looking in a market and you're looking at a major swing to turn around on a much higher time frame, and you're looking at a lower time frame, looking to refine your entry and exit, you may have a couple of false attempts at entering the market. You may jump into the market and it goes against you a little bit, and as a result you make another attempt. Using a 3-bar stop is a simple technique that you can use to establish a stop, particularly if the market's a little difficult to read. And you want to be able to get into the market so that you can take advantage of the longer swing or trend. But you want to do so when it works to your advantage, and you still have to maintain some kind of a stop, even though the market may be a little difficult to read. In a case where you only have lows or highs to work with, for example, a decline here, it can be rather difficult because of the length of the swing. What if you enter right here? At to what point do you set your stop? How far do you allow it to go back and go against you before you jump out? Jump out too soon and you miss out on all the profit. If you wait too long, then it can go against you rather substantially. For example, entering here and not getting out till it comes down here, well then you've lost out a good bit of the profit you would have made. So you have to look at the situation and the market. But this is one technique that you can use to enhance your trading. The most powerful methodology for setting stops in trade management that we have come across is that of channel surfing. And there's a series of videos that we provide that covers that method. While we're not going to discuss all the degree of activity in regard to channel surfing and how it can be used, we are going to touch on a couple of factors that prove advantageous in consideration with balanced targets, and in regard in particular to setting stops. The market has a unique characteristic where it wants to follow uniformly in certain ways. One way is in regard to trend lines. Trend lines are, of course, nothing more than a line that shows the support or resistance of a market. And there is a bit of an art to this, but it's not difficult to learn. In fact, because of the tendency of uniformity between the upper and lower price range, it is often easy to verify. Still, we're not going to focus on this, but just to make a point about the advantage of using it as a stop. We talked about that a little bit when we were looking at this activity right here, and the advantage of that over the lows used in the market. More than that, though, there's also a natural phenomenon that also occurs in the market called stair-stepping, where many trend lines can be used. Now, stair-stepping in this market, as we look at right here, and we're going to examine this a little closer, what we find is that the market has a habit of consolidating at different points. For example, after this low, we see it consolidate here. It moves higher, and it consolidates just for a bar right here. It moves up a little higher, consolidates for a couple of bars here. And it moves up and consolidates here. It moves up again, consolidates here, and then here, until finally it tops out and changes direction. Now, if you look at that, you have 1, 2, 3, 4, 5, 6 points where this trend consolidated at least to some degree, even though it may just have been a single bar. Now, what does that mean? Well, these points of consolidations, like larger points of consolidations, tend to create levels of support and resistance. If you look at the levels, note what you see. For example, here we have a single bar that consolidated, a doji bar, and it created support and resistance for the 2 bars around it. For the bar before it, it created resistance, although it spiked higher. The close was right on that level. And the open on the following bar, same level, although it did spike a little bit below. Now, I want you to take note of this further consolidation a little later, where we see a couple of bars consolidating, and then we see a bar drop down. Note that it comes down, but doesn't exceed this point of reference. It acts as a support. Now, it's not really a low, as we would use, or what would be typically used, but it is a point of reference that can be used as a limit for a stop. In turn, once this market moves higher, again, you can use these highs, particularly with a focus on the closes of the bars, as a point of reference for the next stop. The market moves up and declines, but note it doesn't even reach the highs. Now sometimes it will reach the highs and find support where the bars tend to close or linger. But for the most part, even the high, as you see in this case, it finds support and bounces and continues higher. This market tries to come down, but again, here's the high, here's the low. Considerable difference between the two. The market moves higher, and you see the market again consolidate, nowhere near the prior highs that we saw before. And then again, the market moves up, and here you can set a stop even at this point or level, and when it declines, get out of the market right there, which would, in effect, provide a substantial gain based on the move that we see an entire trend. Now what's advantageous about this is that first off, it's a little bit different approach than what you may have learned in using prior lows or highs as a stop. You may have learned use this as a stop, use this as a stop, use this as a stop. And you can see that in each case, this is so much further down than what we were looking at prior. And as a result, it means that you have a tighter stop that's more dynamically in line with the activity of the market. In using this, you have to look at the geometry and what you focus on. You're not focusing on the lows or highs, but the overall limit that the market is setting as a support and resistance line. And it does this, although on a small scale, which takes some subtle observations. The fact is, it does provide a limit. When we look at further activity in the future, we also find that there are situations where the market may get hung up, as we see right here, where you're kind of limited into what point you will use as a stop. But if they're not available horizontally, oftentimes the trend lines are available on a diagonal basis. For example, here we have a series of highs going through just as we would use a balance target. Do you see that? We find our stop right at this level. This gives us an advantage of using the balance targeting, as we've already learned, as a basis for a stop and a reference. But when you're dealing with subtle aspects, sometimes all you have to do is look at the market itself. Where do you see a consolidation creating a natural level of support or resistance? Remember, consolidations are in fact a point where people had trouble deciding whether the market's going higher or lower. A point of indecision where a battle occurred and finally someone won out. It is seen as a reference of a price level of significance. While it may not be extremely so and easily broken, the fact is that as a reference for a quick stop, it does prove effective. Indicators. Some people love them, some people hate them. In this computer age, it is undoubtedly that you have used them at some point in time, and you may have some favorites that you rely on heavily. Using balance targeting in conjunction with indicators is a great way of enhancing the ability to use both the indicators and to use the targeting as well. The fact is that most indicators tend to be lagging. But if you have a specific price area or zone to trade from, then there is some advantage to using them. Let's take a look at a few indicators in relation to this market that we've been looking at and see how we would use them. First off, let's go back and review a couple things. We did know, for example, that we had a balance target here and we were looking for a move within this approximate area above $2.10. We also have this target coming back the other way, and we seem to be, or to have hit it just recently in the market, so we currently have that as well. Now, from a trader standpoint, obviously you would be looking to, after having taken advantage of the swing, to exit out of here and look for a point to short the market to take advantage of the expected decline. Now, how would you use an indicator to accomplish that? Well, let's take a look at a few indicators and see how we would do just that. One of the first indicators that we want to look at is that of the stochastic, which is a rather popular indicator. And as with any overbought, oversold indicator, it has certain advantages and works well with consolidations, but does have an issue when you get to a strongly trending market, so which you'd have to be cautious about. But a stochastic in its basic form works like this. You have two lines that act as a moving average. They cross over, as you see here and here, and when they do, they create a signal to buy or sell. But it has some refinements. In addition to that, it has what's called an overbought and an oversold line. When the lines are above the overbought line, well, the indication is that the market's extended too far and should decline off of that. When it goes below the oversold line, well, then the indication is that it's been sold too much and needs to return or move back up. And in this case, you can see both cases that it's worked quite well. But it doesn't do that in every case. For example, you have a situation here where the market changed direction and yet never reached down to the oversold. And clearly it was a clear signal to buy into. Now this fact creates a situation where you may have a false signal. And some false signals are the problem with the indicator. But it does have one additional factor that you can use to your advantage, and that's what's referred to as divergence. Now divergence works this way. In price, you may have higher highs forming, as you see here. In contrast, the stochastic line should be doing something similar, forming higher highs. And when they fail to do so, as you see right here, then a divergence occurs. A divergence means that basically, if I took a trend line from this high to this high, and you see it inclining, I should get a similar situation, although it may not be exact, in the lines that occur in stochastics. In this case, though, I don't get that, do I? At best, it's horizontal, and it does look like it is even lower, the second point, as opposed to the first point, opposite of that, what we see in price. And this divergence is a clear indication that something's wrong. The market's really changing direction, and there's a concern. Now, in this case, the divergence didn't work quite as well. It formed a consolidation, and the market lingered for a while, but it really didn't go anywhere, so it wasn't the best signal here. But if you look later, you see divergence in another place. For example, you see this high, and you see this high. Very clearly, there's a difference between the two. In the lines themselves and stochastics, what you see is, again, a divergence. And clearly so. And in this case, the signal that's given was a good one because the market declined very powerfully off of that. Now, I want you to bring your attention back to the things we discussed earlier about our targets. Where was our target on the upper level? Well, it was right over here above $2.10. Where was the key divergence? Well, right here in line with that target. You see how they work hand in hand. Without the targets, well, then it's a little bit more difficult to know which signal is going to work to your advantage and which aren't. And that's one of the key elements in regard to refining an indicator. By using the two hand in hand, then suddenly they bolster one another and give each other the opportunity to work effectively. In regard to the targets, we can see where we are beginning to narrow down here in an oversold situation, and we are at, of course, a target. So when this crosses over, which it looks like it's about ready to do, then guess what? Well, then it's time to buy. And so this would be an opportunity or a point to take advantage of. Now, the problem is that you don't have quite a divergence as you did in the other case. And so, again, you're missing something. You have lower lows, and you also have a bit of lower lows in this market as well on the stochastic. So the stochastic does have a limitation. If we go back and come back later, we could possibly see the difference between the two and how strongly the balanced targets work over top of the indication that the stochastics give. in any event, it still will provide a signal when this market changes direction, because as it starts to make a move higher, well, these will cross over as well, and you'll get an indication from the lines that it's moving higher. That fact will still give you the opportunity to enter and exit at a reasonable price in line with the targets, thereby using the indicator to bolster the targets. Another favorite indicator is that of the MACD. Now the MACD, unlike that of the stochastics, is a momentum indicator, and we can see it in the center here. Now this particular MACD has the lines that indicate the MACD and a crossover moving average. It also has a bar differential, as you see in kind of in a blue-green color, and that shows the differences between the two lines, between the moving average and the MACD line, giving you an idea early on when the change takes place. Now the MACD is really designed for momentum indication and take advantage of that. What that means is this, is that obviously a change such as what we have right here is not what it's really designed for. What it's designed for is that once the market gets underway and starts trending a specific direction, when the market comes back and looks for the line and then starts to draw away from it, indicated by not only the line but the bar differential that develops as well, then we have a sell indication as we do here. The signal to enter the market would be taken at that point. The differential itself gives you a little bit early warning. If you go back to this crossover, as we see here, let's take note of where we see our change in direction, as we see in this bar, and you can see that the differential comes in a little earlier because you see this bar a little lower than the prior bar. However, the crossover doesn't occur till later, meaning that the signal to enter would be late if you waited simply for the crossover. To facilitate a better opportunity to be aware of these signals, we've added a secondary indicator here, and instead of two moving averages, the blue set in at 5 periods and the red set at 1 period, so it's very sensitive to any changes in direction, and a crossover happens quite frequently. Now most of these crossovers are ignored. What's the key is the price level that you're going to be meeting that is in line with your target. Now if you look back at this MACD, because it's a momentum indicator, you'll find that, well, it's late for this entry, but it's not too bad if you get in over here, taking advantage of the move. Again, also here, there's a point where you can enter. The change in direction to exit, well, that's a little bit different, a little bit more tricky. That's why another tool such as a moving average, stochastics, or some other tool would be necessary. Even more important is, of course, the price targets that we would determine with the balanced targeting. Now, where balanced targeting plays a specific role in helping the MACD is the fact that in many cases you will see the line continuing higher and higher or lower and lower, crossing over and eventually reaching a high and turning around. It's when you have the price point or price level, as we did here, that when you start seeing that met and the bars themselves and the differential start to decline, or the MACD lines start to develop a hook and change direction, that's when you know that it's time to get out of the market and take profits. You can also add an overbought oversold indicator as well. But in any event, the secondary factor is also when you would normally enter with a MACD, such as right here, which would be within this area. The key is, what is the price target that you're looking for? And knowing how far you're looking for a profitable trade can make a difference, because if you're just looking at a consolidation, then the trade's not going to prove too successful, and the more risk you expose yourself. The greater the profit opportunity, well, then the less risk you're exposed to if it works your way, because you're looking at greater profits in comparison to the losses. And that's what makes the targets of a great advantage in using the MACD. While this tends to be lagging, there are ways you can speed up or indicate the change. The MACD is designed for momentum, so it's designed to really keep you in trading in a direction of the trend rather than taking advantage of tops and bottoms. And that's an important concept that as a trader you want to also master, because that's where the better profits and more robust moves are going to be. Another popular series of indicators is that provided by Bollinger. Now, Bollinger Bands, which you see located in the price section here, serves a unique purpose in that it measures volatility and changes in that and can be used to buy and sell. The Bollinger Bands, if you look at it, as the market constricts or consolidates, you'll see the bands, the outside lines, tend to constrict as well and narrow. As the market trends or has greater volatility and swings, well, then you will see the lines start to spread apart, as you see here. And this difference in lines, of course, gives you a sense as far as the trending or consolidation factors of the market. But it also provides the buying and selling levels. For example, as the market follows down this line, when it starts to pull away, then you know the buy. As the market rises up to the opposite line and starts to pull away, then you know the sell, etc. Also, Bollinger provides some other indicators. For example, you can also use the Bollinger %B, which has a couple of values. It does measure the difference in the lines, but it also gives a bit of an overbought, oversold indication as well by the nature of the way it works. And you also can get an overbought, oversold, or a divergence situation as well as you would with some other indicators such as the stochastics. And this can prove advantageous when buying and selling or determining when to buy and sell. The key, of course, is always what is the target. The problem with the Bollinger Bands is that, well, you're not quite sure. For example, here it doesn't quite reach the line before pulling away. Do you buy or sell? Here you touch the line and it pulls away, which is fine. But then you get a situation such as you see over here, where the market comes up to just a moving average line, which is the center line, and then begins to decline. And same thing here. It's not as easy to read or determine when to get in and when to get out as one would imagine. Obviously, there are some aspects to mastering the use of this that can create a bit of a challenge for individual traders. However, when you're dealing with the targets, then you have quite a different situation. For example, when we're dealing with the target up here, when we reach that zone in price and that market is being touched by the line, well, obviously those are the key times to exit at least, if not sell the market. And as you can see, the end result is quite strong. The activity can be monitored by what the price tends to do from that point. If it continues to rise for any reason or do anything unusual, then of course you have some factors there that can monitor it. But when you're doubling it up with indicators such as the %B and its indication, then it's a little easier to monitor it when a change takes place in a direction. An example here can be seen as decline. Here we know our price target was approximately right here. And you can see where here we're hitting the line. We're actually starting to draw off of it. So this would definitely be a point that we would consider for an exit. How does the %B stack up? Well, you can see where here's a low corresponding to this low, and this low's here, and we're much higher. So obviously something's changing in the market. You have a bit of a divergence there. And so this would definitely be an opportunity to get out, at least, if not buy the market to take advantage of an upswing. And so using in line with the targets, again, the targets enhance the use of the Bollinger Bands, if that's the indicator that you prefer to use. Reversal dynamics is an extremely powerful time-based method, and it utilizes the geometry of the market to determine in advance when the market can be expected to change direction. I've taken the liberty of placing these vertical yellow lines here. Each were known in advance long before they occurred as to the signals provided by the method. And you can see that here we have a high, we have a low here, we have a low here, we have a high here, we have a low here, we have a high here, and of course where we're currently looking at a low at this point. The power of this is quite effective even by itself, but in conjunction with balanced targeting, you can see how the power really comes out. For example, of course we had our target up here, so we were looking for an exit and a profit-taking opportunity somewhere at this price level. With the reversal occurring at the same time as at this bar, this would be a point of exiting and even selling the market for the expected decline that was due to follow. The other target we were looking at, of course, is down here, which means that we currently have a reversal due right here, which would be not only the exit for the decline, but a buy opportunity to take advantage of the up move. You can see the effectiveness of the method in conjunction with balanced targeting. And we teach this method, and it's available through the course, video course, through the series that we provide. So we strongly encourage you to learn the method and take advantage of it to the full in utilizing it with balanced targeting. Balanced Dynamics video number 5, Methods of Trading Balanced Targets. All methods and techniques are those developed by Michael J. Parsons. The videos are narrated by Michael J. Parsons. Director of Marketing, Osman Musa. Technical support, Melissa R. Parsons. Accounting, Ray V. Parsons. And translation, Heather L. Parsons. This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization.